Commodities futures trading affects the economy by changing the prices of food, energy, and metals. Thanks to commodities traders, commodity prices can be affected by more than just the laws of supply and demand. For example, commodities are traded in US dollars. As the value of the dollar increases, the price of commodities falls. That's because traders can get the same amount of commodities for less money. 2015, traders sent commodities prices plummeting. In 2014, the dollar index rose 15%. By 2015, aluminum prices had fallen 19%, and copper prices were down 27%. Oil was hit the worst, as prices fell to a 6-year low. Supply and demand had some impact as well. China's economy started slowing, reducing demand for copper. As part of its economic reforms, China was shifting from construction to consumer spending. It wanted to rely less on exports, and more on domestic demand. That further reduced the need for copper, since housing construction uses a lot more copper than consumer products. China's construction industry had used 3 to 4 million tons a year. That's equal to what was used by the entire economies of the United States, Japan, Canada, and Mexico combined. China also added to the supply of commodities, further lowering prices. In 2014, the country produced 52% of global aluminum. It boosted that amount in 2015, adding 10% to supply. Source: Metal Meltdown, Bloomberg Business Week, October 11, 2015. China is also entering the commodities trading markets. The Shanghai Gold Exchange sold $200 million of gold in July 2015, sending prices down worldwide. It traded 316 tons in July, a 44% rise from last year. The Bank of China became part of the London-based gold fixed price setting mechanism. The Shanghai Futures Exchange trades 31% more steel, zinc, and aluminum. The London Metals Exchange was bought by the Hong Kong Exchange. 2008, traders created oil price bubbles. One of the most critical commodities is oil. The price of oil changes daily, which has an impact on every good and service produced in America. As traders take into account all information regarding oil supply and demand, as well as geopolitical considerations, this affects oil prices. It is these assumptions behind oil prices that affect the economy so significantly. For more, see why are oil prices so high? For example, in 2008 oil prices skyrocketed. That was despite the fact that global demand was down, and global supply was up. The Energy Information Administration reported that oil consumption decreased from 86.66 million barrels per day, BPD, in the fourth quarter of 2007 to 85.73 million BPD as of in the second quarter 2008. During this same period, supply rose 85.49 million BPD to 86.17 million BPD. According to the laws of supply and demand, prices should have decreased. Instead, by May prices rose almost 25%, from $87.79 to $110.21 per barrel of oil. The EIA reported that the flow of investment money into commodities markets caused the trend. Money that traders had invested in real estate or stocks was diverted into oil futures. Later that year, frenzied commodities traders drove the price up to its all-time high of $145 a barrel. Traders caused food riots. Commodities traders were also responsible for high food prices that created riots in less developed countries. First, funds were also directly diverted into wheat, corn, and other commodities. Second, high oil prices lead to higher distribution costs for food. For more, see what is the real reason for high oil prices? Thank commodities traders for high gas prices. In January 2013, traders bid up oil prices early in the year. They were concerned about a potential threat on of the world's most strategic oil shipping lane. Iran created the fear by playing war games near the Straits of Hormuz. By February 8, oil prices had risen to $118.90/barrel, sending gas prices to $3.85 by February 25. That occurred earlier than in 2012 when Iran threatened to close the straits. Traders didn't bid up oil prices until March, sending gas prices higher in April. In 2011, oil prices didn't start rising until May, sending gas prices up immediately. That was a result of traders anticipating higher oil and gas prices due to higher demand from the summer driving season. Oil makes up 72% of the price of gas. When oil prices rise, it usually shows up in gas prices 3 to 6 weeks later. For more, see how crude oil prices affect gas prices. Why are gas prices so high? High gas prices are caused by commodities traders. They bid up the price of gas contracts on the commodities futures markets. These commodities exchanges allow investors to buy contracts of gasoline for future delivery at an agreed-upon price. However, many traders have no intention of taking ownership of the gasoline. They plan to sell the contract for a profit, instead. High gas prices are also caused by high crude oil prices. That's because oil costs account for 72% of the price of gasoline. The remaining 28% comes from distribution, refining and taxes, which are more stable. When oil prices rise, you can expect to see it at the gas pump 6 weeks later. Like most of the things you buy, both gas and oil prices are affected by supply and demand. Since 2008, both gas and oil prices are affected more by the ups and downs in these futures contracts. The price depends on what investors think the price of gas or oil will be in the future. When traders think gas or oil prices will be high, they bid them up even higher. In this way, commodities traders create a self-fulfilling prophecy. This leads to an asset bubble. Unfortunately, the one who pays for this bubble is you. You can expect prices to rise every spring. It seems to get earlier and earlier each year. That's because oil futures traders know demand for gas rises in the summer as families go on vacation. They therefore start buying oil futures contracts in the spring in anticipation of that price rise. Gas and oil prices rise when the value of the dollar declines. That's because oil contracts are all denominated in dollars. Until the dollar strengthened in 2014, the 40% decline in the dollar since 2002 put upward pressure on oil prices. Why are prices going up right now? In August, gas prices rose from an average of $2.58 a gallon to $2.62 a gallon. This spike was due to an outage at BP's Whiting refinery in Indiana, making prices in the Midwest higher than average. Source: The Daily Shot, August 14, 2015. In California, the price at the pump rose to near $4 a gallon in July 2015 due to Midwest refinery problems that sent California's oil elsewhere. Since doesn't have major pipelines from other regions, it has to wait for tankers with imported oil to arrive. A similar thing happened in 2012, and was just a temporary regional problem. When else have prices been high? Prices rose in April 2014 because the price for domestic oil, West Texas Intermediate, rose to $101 a barrel because new pipelines from the Cushing, Oklahoma storage hub lowered inventories to the lowest level since November 2009. In addition, the price of imported oil, North Sea Brent, rose to $110 per barrel thanks to political unrest in Ukraine, Nigeria, and Iraq. The Energy Information Administration expected average national prices to remain at $3.60 a gallon until May. In early 2013, Iran started war games near the Straits of Hormuz. Nearly 20% of the world's oil flows through this narrow checkpoint bordering Iran and Oman. If Iran threatens to close the straits, it raises the fear of a dramatic decline in oil supply. Oil traders bid up the price to $118.90/barrel by February 8 in anticipation of such a crisis. Gas prices soon followed, rising to $3.85 by February 25. They rose again in August 2013 because oil prices hit a 15-month high that summer. That spike was created by political unrest in Egypt. In September 2012, prices rose to an average high of $4.50 a gallon in California. That was because of supply shortages from two causes. The first was a power outage at the Exxon refinery in Torrance, CA, which itself was caused by a heat wave. The second was a shutdown of a major north-south oil pipeline. These came on top of East Coast refinery shutdowns due to regular seasonal maintenance. Although prices have dropped a bit in October, chances are they won't drop much further for the rest of 2012. In August, prices were high as a result of Hurricane Isaac, which hit the Gulf Coast region on August 28, 2012. In anticipation of the Category I hurricane, refineries in the area shut down production. As a result, crude oil production lost 1.3 million barrels per day. This caused the average national price of gas to jump $0.05 in one day to $3.80 on Wednesday. Prices in Ohio, Indiana, and Illinois rose even further, as the storm closed a pipeline that feeds the Midwest. In February 2012, concerns about a potential military action, by either Israel or even the U.S., against Iran caused high oil prices. Second, some oil refineries in the U.S. were closing, according to an EIA report. Third, oil and gas prices tend to rise every spring, in anticipation of increased demand during the summer driving vacation season. As a result, the prices for a gallon of gasoline hit the benchmark $3.50 by February 15, 2 weeks earlier than in 2011. By mid-March, the national average had jumped to $3.87 a gallon. That's because the price of oil reached its benchmark of $100 a barrel 2 weeks earlier, as well. Oil went on to hit $109.77 by the end of February, before dropping slightly to $107.40 in mid-March. In April 2011, fears about unrest in Libya and Egypt sent oil prices up to $113 a barrel. In May 2011, as oil prices dropped, the price at the pump stayed high. Why? Commodities traders were concerned about refinery closures due to the Mississippi River floods. In the summer of 2008, gas prices rose to $4.17 a gallon as oil prices skyrocketed to $143.68 a barrel, even though demand and supply were fairly constant. During the 2008 financial crisis, commodities traders drove up the price of oil, even though supply increased and demand fell. The EIA cited an increased flow of investment money into commodities markets. In other words, money that used to be invested in real estate or the global stock market was instead being invested in oil futures. For more, see gas prices in 2008. In summer of 2009, the price at the pump again rose, despite the recession, which decreased demand. Commodities traders were the reason for both. Prices also usually rise during the summer vacation season, as driving increases. Finally, gas and oil prices also increase whenever there is concern about surging demand from China and India, or a curtailment of oil supply. What makes high prices drop? The summertime vacation driving season usually increases gas prices by an average of 10 cents per gallon. This price increases despite the increased use of ethanol. Prices usually fall in the winter, since transportation needs are lower. This even offsets an increase in oil usage for winter heating in the northeastern United States. What can we do about it? The most immediate thing we can do is reduce our usage of gas, either through driving less or increasing fuel efficiency. Surprisingly, the best way to increase fuel efficiency is to keep tires inflated. These, and other suggestions, are included in the related reading section of this article. Longer term, we can change our need for oil and gas by switching to alternative fuel vehicles, using public transit and moving closer to work to reduce commuting time. This will reduce the impact on each of us individually by reducing use. Could this reduction in itself reduce the high price of gas? It could, if it could reduce demand for oil enough to lower oil prices. It would have to happen on a sustained basis over a long period of time. That's because gasoline accounts for only 20% of each barrel of oil. Oil companies would still profit from the non-gasoline parts of their business. Therefore, even if consumers could conceivably stop 100% of gasoline use, oil prices might only decline 20%. Would a gas boycott work? Could a gasoline boycott halt rising prices, even if oil prices stayed high? Probably not by much. That's because the other elements that go into the price of gas would take a long time to change. Taxes, which comprise 13% of gas prices, would require legislative approval, which could take months. Refinery costs, 8%, couldn't be lowered, and neither could distribution costs, 7%, both of which are fixed. A boycott of one brand of gas could actually increase prices, since there would be fewer gas outlets. Those companies that were boycotted would simply sell their gas to those that weren't boycotted, defeating the purpose. A boycott of all gas companies would lower prices if it impacted the oil business. Only 20% of oil is used for gas. Perhaps the oil companies could get by with a 20% loss for a while. They might just raise prices on jet fuel, heating oil, and other industrial uses. In addition, other pressures on the price of oil, such as dollar decline and commodities traders, would not be impacted by a gasoline boycott. Crude oil prices make up 71% of the price of gasoline. The rest of what you pay at the pump depends on refinery and distribution costs, corporate profits, and federal taxes. Usually, these costs remain stable, so that the daily change in the price of gasoline accurately reflects oil price fluctuations. It usually takes about 6 weeks for oil price changes to work their way through the distribution system to the gas pump. Oil prices are a little more volatile than gas prices. That means oil prices might rise higher, and fall farther, than gas prices. Examples of how oil prices affected gas prices. Oil and gas prices have been especially volatile since the 2008 financial crash. Here's a look at their peaks and valleys, and what caused the price swings. 2016, prices of oil and gas will rise. For more, see crude oil price forecast for 2015 and beyond. 2015, prices for WTI crude fell below $37/barrel in December. That drove gas prices below $2 a gallon. In 2014, the country produced 52% of global aluminum. It boosted that amount in 2015, adding 10% to supply. Source: Metal Meltdown, Bloomberg Business Week, October 11, 2015. China is also entering the commodities trading markets. The Shanghai Gold Exchange sold $200 million of gold in July 2015, sending prices down worldwide. It traded 316 tons in July, a 44% rise from last year. The Bank of China became part of the London-based gold fixed price setting mechanism. The Shanghai Futures Exchange trades 31% more steel, zinc, and aluminum. The London Metals Exchange was bought by the Hong Kong Exchange. 2008, traders created oil price bubbles. One of the most critical commodities is oil. The price of oil changes daily, which has an impact on every good and service produced in America. As traders take into account all information regarding oil supply and demand, as well as geopolitical commodities futures trading affects the economy by changing the prices of food, energy, and metals. Thanks to commodities traders, commodity prices can be affected by more than just the laws of supply and demand. For example, commodities are traded in US dollars. As the value of the dollar increases, the price of commodities falls. That's because traders can get the same amount of commodities for less money. 2015, traders sent commodities prices plummeting. In 2014, the dollar index rose 15%. By 2015, aluminum prices had fallen 19%, and copper prices were down 27%. Oil was hit the worst, as prices fell to a 6-year low. Supply and demand had some impact as well. China's economy started slowing, reducing demand for copper. As part of its economic reforms, China was shifting from construction to consumer spending. It wanted to rely less on exports, and more on domestic demand. That further reduced the need for copper, since housing construction uses a lot more copper than consumer products. China's construction industry had used 3 to 4 million tons a year. That's equal to what was used by the entire economies of the United States, Japan, Canada, and Mexico combined. China also added to the supply of commodities, further lowering prices.